Hello, I'm Ben Jones and welcome back to Dukascopy TV. It's Friday, so joining me on the line to bring you the weekly wrap-up is Francois Stofberg from the Efficient Group. Now Francois, this week has been dominated by European data. Before we discuss yesterday's interest rate decision, I'd like you to talk about the significance of the unemployment rate and the GDP figures. The unemployment rate dropped slightly to 11.7% and the GDP growth rate reached 0.9% on an annual basis. What do these figures show for the Eurozone?
I believe these figures are hinting towards moderate growth in the Eurozone. Growth was under pressure, but not enough to move the European Central Bank's hand directly into capital markets, but rather into banks' back pockets, nudging them forward. There has been lackluster indicators from different Eurozone economies, but most notably, German industrial production rose 0.2% seasonally adjusted, which shows that Europe's largest economy will continue to grow at a solid pace towards 1.7% in 2014, even though the Bundesbank said that growth would slow noticeably after faster than expected growth in the first quarter. Good news also came from Spain, Europe's fourth largest economy, where industrial production increased the most in 4 years. Production at factories, refineries and mines increased 4.3%, which was much higher than expectations.
Obviously, yesterday was the day of the interest rate decisions. As well as the Euro area, the UK had an interest rate decision, which they held at 0.5%. Was this expected by most?
I don't believe it was expected by most, but economic indicators in the UK are looking very favourably compared to other developed economies, especially with higher long-term rates and more French decoupling expected. Even though the trade balance is widening due to strong sterling, manufacturing PMI settled into 57, construction at 60 and services higher at 58.6. The pound sterling reached an 18-month high against the euro, increasing by 8.8% in the past 12 months. Sterling also gained against the dollar after the decision to keep interest rates unchanged. The question, however, remains when will they start raising rates out of the all-time low of 0.5% to the 1%, which most economists are expecting, as reported by Bloomberg. I believe this decision goes hand in hand with pickup in the Eurozone and the rate at which the Fed tapers.
So the biggest event of the week, the ECB rate decision. It dropped from 0.25% to 0.15%. Why do you think they chose this figure, and do you think it will have the intended effect?
Well, the exact figure might not be as important as the signalling policy package introduced, which they believe will have the intended effect of lifting Eurozone growth. Signalling with a 400 billion euro loan program, which is dependent on the bond, of course, rather than storming the primary markets, which economists at HSBC and Schroeder Investment Management now believe will only occur next year. Fresh stimulus will be well received after Europe reached inflation of 0.5%, which with more downward risk, and both the Fed and the Bank of England move toward withdrawing stimulus. Mario Draghi is trying to stimulate the economy by bank interaction rather than bond market intervention. They stopped short-term programs that remove stimulus and instead opted for negative deposit rates, which of course is a first for any major central bank. We can only hope that they do not fall into the same turmoil of failing policy packages as the Japanese did.
Francois, thank you very much for joining me today. That's all we've got time for, I'm afraid. That's all from me for this week as well, but keep clicking back next week, as we'll have plenty more updates and exclusive interviews for you. Bye for now.